Welcome to part 3 of our deep dive into the Dhandho Investor by Mohnish Pabrai. In this segment, we'll explore how to apply the Dhandho framework to find hidden gems in the market and understand the deep-seated principles that set this approach apart from traditional investing. In part 1, we learned about the foundational mindset and how low risk can lead to high returns. In part 2, we dug into Pabrai's focus on finding businesses that have a significant margin of safety and strong moats. Now, part 3 takes us deeper, focusing on the actual process of identifying these opportunities and assessing their long-term potential. Pabrai urges us to focus on businesses that have an enduring competitive advantage, a moat that can withstand the test of time. He gives examples like Coca-Cola, American Express, and other giants that have dominated their industries for decades. According to Pabrai, a business worth considering is one that can maintain or even expand its competitive position over 10, 15, or 20 years. These businesses often have strong brands, pricing power, and customer loyalty, making them highly resistant to competitive threats. He then talks about the concept of arbitrage, making low-risk, high-reward bets where the odds of success are stacked in your favor. This doesn't mean gambling blindly or chasing every opportunity. Instead, it means looking for situations where the market has mispriced an asset. Sometimes this happens due to short-term setbacks, industry downturns, or irrational market behavior. The Dhandho approach is about finding these moments of dislocation and acting decisively. Another core tenet of Part 3 is focusing on the circle of competence. Pabrai insists that you must only invest in businesses you thoroughly understand. This means resisting the temptation to expand into areas you don't comprehend, no matter how enticing the opportunity might seem. By narrowing your focus to industries and businesses within your area of expertise, you can make better judgments and spot mispricings when others fail to recognize them. Pabrai also introduces the concept of cloning as an investment technique, a powerful idea rooted in humility. He suggests looking closely at the moves of great investors like Warren Buffett, Charlie Munger, and others, and learning from their decisions. The goal here is not to copy blindly, but to understand why certain investments were made and how those lessons can apply to your own approach. In other words, stand on the shoulders of giants. He also reminds us of the vital role patience plays in the Dhandho approach. The best returns come from making a few concentrated bets, then allowing time to work in your favor. The market may not recognize a mispriced gem immediately, and that's okay. The patient investor can wait for the market to adjust, confident in their understanding of the underlying value. To summarize Part 3, focus on businesses with long-lasting competitive advantages. Practice arbitrage by finding low-risk, high-reward opportunities. Stay within your circle of competence and deepen your expertise. Embrace the idea of cloning successful investments. Maintain patience and discipline to reap long-term rewards. This approach to investing is about thinking differently, about focusing on quality over quantity, making intelligent bets, and letting time and compounding do their work. In Part 4, we'll bring it all together, exploring how to build a portfolio that captures the essence of the Dhandho approach, and discussing Pabrai's final words of wisdom for making low-risk, high-return investments. Stay tuned, subscribe, and join us as we continue to unpack this timeless classic in value investing.